What we know about the Dow is it's very industrials heavy. And what's infrastructure? It's industrials, right? Whereas the S&P, a little bit more to tech, a little bit more to financials, which tend to be driven by different elements of the economy and a different relationship with inflation. So I don't know. I'd have to look at those dates pretty closely. But it's an interesting relationship.
You're not going to be including it on any of your chart packs. All right.
Can I add to that?
Yeah, please.
That's a great point. I've also got, I don't know if you want to jump in the terminal, but I've got the sector breakdown here. This is part of it, as Jeff points out. You've got big industrials, about a 20% weighting. Tech has a smaller weighting. Now it's 17%, but if you look at the S&P, tech's a lot closer to about 20, 21. So if you're of the belief that there's going to be a big rework in terms of the trade, agreements and whatnot, then potentially some of those sort of multinational and big tech companies could have some problems. Then you've also got financials about 17%. So that's going to be helping as well, as we've seen those financials do pretty well. Bigly, as they would say.
Bigly. Nice.
Or big league. I believe it's big league.
Well, that's related to the story we were just talking about the steeper yield curves. And this is true globally, right? We just saw it in Germany. We've seen it in a number of places. That's helping financials not just in the U.S., but around the world. True for industrials as well. Industrials everywhere, even in Asia, are picking up on this. Trump having global implications for bonds and stocks.
No, absolutely. Although, having said that, when you look at how some of the companies within the U.S. are performing, you point this out in your latest note on equities, which was fairly bullish overall. Small cap companies are doing better than large cap companies. And maybe, Oliver, you can speak to this chart here with the Russell 2000 outperforming the S&P 500.
This is fascinating because, as Jeff and I were just talking about, going into this event, the election, the markets had a very sort of risk-off kind of mentality about the Trump's potential Trump victory. It was going to be volatility. We saw markets doing poorly on days in which it
People
polls
were
did
warning
well.
of recession.
Right, but now, not only is it not risk-off, it is extremely risk-on. People are finding it advantageous to get into what is typically the most high beta part of the market here, which is small caps. But then it comes back to the sector breakdown as well. The same thing is happening here, where they're heavily weighted to financials. That, as we've shown before, painstakingly so, that they're the most tied to Trump's chances, and it's also domestic facing. So if you're doing the whole, America first attitude, and we're going to put all our money here.
You got to figure small cap finance likes deregulation.
Absolutely, and they probably also apparently might like higher rates. It's a big loan lending part of the business as well.
Something you alluded to was steepening yield curve having ramifications across all asset classes. I got a chart here. We're talking about the ever controversial Fed model, which tries to come up with some relationship between bond valuations and stocks. If bond yields go up, that's bad for certain categories of stocks. What do you think of stock valuations here in light of a rising rate environment? Is there a connection?
Well, there's always a connection between interest rates and stock prices. I think stocks being very much tied more to earnings prospects, I think, in the next year, after 2 years of an earnings recession, than necessarily where interest rates are headed. Valuations may be under a little bit of pressure, given the uncertainty of what a Trump presidency means in terms of how it'll govern. But what we do know is earnings likely at a turning point. They're the lifeblood of the stock market.
Yeah, when you look at profit margins, and I know that this is overall not just for the U.S. companies, but for global companies, you say that they're in the middle, but not the top of a long-term range, 20 years, right?
This is so important. 10 years ago, when we look at the lost decade here for the equity market and for earnings, one of the reasons is profit margins were at all-time highs. They are now just below the long-term average. That means we don't have that drag of slowly drawing down our revenue per unit anymore and have to grow sales volume to keep up with it. That's great news for profits going forward.